Welcome back to the Tax Equity Modeling course, and in this lesson, we will start modeling the tax credits that our renewable project is eligible for. The first tax credit that we will be modeling is a production tax credit, or PTC, and it is relevant for the wind projects. To model the PTC, we will have to determine the period when the project can claim the PTC, and, therefore, we will have to model the PTC flag, which will give us a value of 1 when the project can claim PTC and 0 otherwise. To model the PTC flag, we will have to have the operation start date because wind projects are eligible to claim PTC once the project has been put in service. That is when operations start producing energy, and then, based on the PTC length, which is 10 years, we will model the PTC end date. We will use the operation start date and PTC end date to model the PTC flag. So, let's bring the operation start date from the timing worksheet. The operation start date is in the cell D48. Let's color the row 48 red, because we will be exporting the link to another worksheet. Let's now copy the cell D48. Let's go back to the SPV worksheet, and let's paste the link to the cell D181 with Alt-HVN, then F2, F4. Copy across and paste. We can go back to the timing worksheet and copy the formatting of the whole row 48 with a format painter. Go back to the SPV worksheet and paste the formats to row 181. Let's change the color of the link from red to blue because this link is being imported from another worksheet. And we can get rid of the grouping on our left by pressing Alt-A-UU. So, we've got our operation start date, and we know that the PTC length is 10 years. To calculate the PTC end date, we will use the date function. So date, and then the first argument is a year. The year will link to our operation start date in the cell E181, plus the PTC length in the cell E182. The next argument is a month. So, we will link to the cell E181 again. And the final argument is a day, and again, we will link to the cell E181 and subtract 1. Now that we have defined the year, month, and a day for our date function, let's hit enter. And you can see, we are getting the date of December 31st, 2030, which is the last date when we can claim the PTC for this project. Next, we will have to bring the operation start date and PTC end date to rows 185 and 186. First, let's copy the operation start date, and to do that, let's select the whole row 181, copy it, and paste it to row 185. And then, we have to bring the PTC end date. So, let's copy the cell D183 and paste the link to the cell D186 by pressing Alt-HVN. Copy across and paste. Let's now copy the formatting of row 183. Select the whole row, copy it, go back to the destination row 186. Select the whole row and paste the formatting by using the shortcut key Alt-ES and select Formats. Next, let's bring the financial period end dates over here. We have already used the financial period end dates in the revenue calculation block on this worksheet. Let's go to the revenue calculations and copy the whole row 18. Now, paste it to row 187. Now, to model the PTC flag, we will borrow the formula and flag formatting from another flag on the timing worksheet. We can use the formula that we used to model the operations period flag in row 64. It is based on two dates, the operations start and end dates, and therefore, it can be used to model the PTC flag, which is also based on two dates. Let's copy the cell 64. go back to the SPV worksheet, and let's paste it to the cell I-188 by pressing the Ctrl V. Now, we have to go inside the formula and change the cells, which have an absolute reference. So we remove E61 from the formula, and instead link to the operation start date in the cell E185. Anchor it by pressing F4. Next, we remove the E62 from the formula, and link to the PTC end date in the cell E186. And then press F4 to fully lock the cell, and this is all that we need to do. Hit Enter. Copy across and paste. Let's take the sum of the cells we've just modeled. The sum of all the flags is giving us 40, which means that the project is eligible to receive PTC in 40 quarters. Since this is a quarterly model, this is a correct number of flags that PTC flag should have, because PTC length is 10 years, times 4 quarters in a year will be 40 quarters. And we can also check the date that corresponds to the last flag, which is December 31st, 2011, which is the same as the PTC end date in the cell E186. Now that we have completed modeling the PTC flag, we can calculate the PTC earned by the project. PTC credit is $15 per megawatt hour, and this is according to the case study, and it is based on the fact that if the project construction started in 2018, which is the case for this project, then the project is eligible to receive 60% of the full PTC credit of 2.5 cents per kilowatt hour, which works out to be $15 per megawatt hour. Now, let's bring the PTC flag from row 188. Let's copy the cell D188, and let's paste the link to the cell D191 by using the shortcut key Alt-HVN. Let's select the row 188 and copy the formatting with Format Painter, and let's paste the formats to row 191. We will have to bring over here the net generation and escalation factor, and we can bring them from the operating costs calculations block. We've got the net generation in row 68. Let's copy the whole row, and let's paste it to row 192. The escalation factor is in row 67, so let's copy the whole row 67. And let's paste it to row 193. Remember that we modeled the net generation and revenue calculation block. However, we use the net generation to calculate certain variable costs. Therefore, in operating costs calculations block, net generation is a link, and the row is anchored. Therefore, we could simply copy the whole row and paste it here and preserve the link to the original calculation cells in revenue calculation block. We have to remove the grouping that we have on the left, and to do that, we press Alt-AUU. So, PTC earned is PTC credit given in the cell E190, anchor it, times the net generation in the cell I192, because PTC is a production-based credit, and therefore, it depends on how much energy we generate. Next, we multiply by the escalation factor, and times the PTC flag, because we only want to calculate PTC credits when the project is eligible to receive the PTC. And, finally, since our units are in thousands, we divide all this by 1,000. So, over 10 years, the project will generate roughly 42 million of the production tax credit. We will stop here, and in the next lesson, we will model the investment tax credit, or ITC.